S&P 500 futures, the ES, are stuck dead flat this Friday morning. I mean, completely pinned, right at 6,921. We are stalled.
Totally stalled.
The Dow is managing to hold on to a fractionally higher bid, maybe 0.1%. But the real story, the real signal of hesitancy, is coming from the Nasdaq.
Oh, absolutely.
High valuation tech is nursing a 0.4% dip in the overnight session, and we're seeing yields firming up pretty aggressively ahead of the opening bell.
And what's driving that flat reading, it's this massive tactical rotation that's been underway for, 72 hours now? The New Year momentum rally has just hit a wall.
In a brick wall.
Because institutional money is executing a really sharp pivot out of those overextended AI hardware names.
The ones that carried us last year.
Exactly. And they are rotating sharply into security and cyclicals. So we're sitting dead neutral on the surface, but underneath the hood, the entire market structure is changing in real time.
And it's waiting for those two big events.
Waiting for two high-stakes macro events to drop this morning.
That structural change is so clear when you look at the bond market. That's what you have to watch most closely today. The 10-year yield is holding 4.19%.
Just creeping right up to that 4.20% psychological ceiling.
And critically, the dollar index, the DXY, has now rallied for a third straight session. It just touched 99.03.
That's a one-month high.
Right. So, for you listening, if you're not charting currency markets every single day, what does a strong DXY combined with rising yields immediately signal for your equity portfolio?
It's the double squeeze on growth, especially tech. A higher DXY, so a stronger dollar, it just erodes the overseas earnings of massive multinationals. Think Apple, think Microsoft.
Makes their foreign sales worth less.
Worth less when you convert them back to US dollars. And then at the same time, those rising yields are deflating the future value of those same high growth companies. It's tightening financial conditions across the board.
Which is exactly why the market is holding its breath. And what we're holding our breath for, first up, is the 8:30 a.m. Eastern print, the Non-Farm Payrolls, or NFP. Consensus is pretty muted, expecting just 60,000 jobs.
And this is our first clean data set on the labor market after that messy government shutdown in the fall.
Right.
So the stakes for NFP couldn't be clearer. If we see a meaningful beat, let's say north of 75,000, that just confirms the soft landing narrative.
The economy is slowing, but not collapsing.
Exactly. But a significant miss, well, that forces the Fed's hand to accelerate the easing cycle we've all been pricing in for 2025. It's binary, but we have to remember NFP is inherently backward-looking.
That is the crucial point. The jobs data tells us what happened back in December. Here's where the forward trajectory gets decided. We are simultaneously on SCOTUS watch. The Supreme Court is expected to rule today on the President's Liberation Day emergency tariffs. That's a trade measure put in place last year.
And that decision, it dictates the entire forward trajectory of global trade and the dollar. This isn't just some trade spat. This is constitutional law affecting commerce. If you connect this to the bigger picture, the SCOTUS ruling has enough weight to unilaterally redraw global trade maps by noon. It would instantly impact logistics and earnings for every multinational for the rest of 2026.
So the jobs data causes volatility.
But the court ruling dictates the long-term portfolio allocation.
And that dual high-stakes threat, a data point that determines the Fed path, and a court ruling that determines the trade path, that explains why we're in this extreme high-stakes compression phase.
It's what traders call the waiting game. Absolutely. Directional conviction is zero until those 8.30 numbers hit the wire.
And maybe even until the SCOTUS ruling drops.
Arguably, yes. The tape is just paralyzed. That rally that carried us into the new year is, well, it's exhausted. And the institutional response? They're defensively shifting into aerospace, defense, and energy.
Hedging.
Hedging against geopolitical volatility, especially what's happening around Venezuela, which has triggered U.S. intervention, and that ongoing civil unrest in Iran.
You can see that pivot so clearly in the sector breakdown. Energy, the XLE ETF, is the strongest sector this morning. It's leading on a definite fear bid.
And that's because WTI crude has seen a sharp bounce due to that U.S. intervention in Venezuela and, of course, the Iran headlines.
It's hard assets over growth today.
Precisely. This is the rotation implication. You see investors moving out of these overextended, momentum-driven AI narratives where profits are, years away, and they're moving into hard assets and defensives. They want confirmed earnings. They want geopolitical hedges.
So you should expect energy to really lead the equal weight S&P today.
I think so. It should significantly outperform the headline performance, even if the futures themselves stay pretty flat.
Okay, let's track that shift directly in the pre-market movers.
Okay.
We've got Lockheed Martin, LMT, and L3 Harris LHX, both moving 4% higher in the overnight session. That is a huge pre-market gap.
And that's a response to a hard, bankable catalyst. The White House proposal to hike 2027 military spending to a record $1.5 trillion.
$1.5 trillion.
That level of confirmed, guaranteed, long-term funding immediately confirms the pivot into the defense industrial base. This isn't speculation. This is confirmed alpha. The smart money saw those headlines and rotated before you even had your coffee.
So we have the fear bid driving defense and energy. But let's talk about an important counter signal that seems to be whispering something different about consumer health. Delta Airlines, DAL. It's up 2.5% pre-market after beating Q4 earnings. Is this resilience a sign that not all growth names are suffering?
It is a crucial countersignal. It highlights the surprising resilience of travel demand. Despite high fuel costs, despite all the geopolitical noise, consumers are still flying.
Which suggests what?
It suggests that while the labor market might be cooling, that high-end consumer spending remains pretty robust. And you need to hold that thought when we look at GM in a moment.
Okay, let's contrast that consumer strength with the volatility in materials. Rio Tinto, RIO, is sliding about 2.5% pre-market.
And that's following the confirmation of merger talks with their rival, Glencore.
And traders seem less than excited about this mega deal.
Well, they're pricing in risk immediately. When you start talking about creating the world's largest mining entity, traders immediately see the antitrust hurdles, the regulatory headaches. The market hates uncertainty, and this deal is just a minefield of regulatory risk.
So for the active trader looking at the tape, what are the hard levels defining that risk for RIO? What's the bull case versus the bear case?
The bull case level is 85.50. If buyers step in today and close the stock above that, it validates the long-term synergy narrative. The bear case, though, is $78. That's the support floor.
And what triggers that?
If the Glencore bid is seen as dilutive, or if regulators immediately signal serious resistance, RIO could hit 78 very, very fast.
Let's move to General Motors GM. It's down about 0.7%. This follows a staggering $7.1 billion write-down on its EV portfolio.
$7.1 billion, that number is massive.
And it's completely overshadowing otherwise decent margins on their traditional engines.
That number isn't just a number, it's a thematic signal. It confirms the extremely high cost and, frankly, the difficulty for legacy auto to pivot to EVs profitably. It raises a critical question.
Which is?
If a behemoth like GM is forced to take a write-down this large, how secure are the valuations of these smaller, pure-play EV startups? This creates a beautiful two-sided trade.
Okay, so where are the lines drawn for GM?
The bull case is 87.50. That's where smart money views this as clearing the decks, cleaning up the balance sheet, signaling a renewed focus on their profitable ICE business. That's the narrative if the economy holds up.
And in the bear case?
$81.
Yeah.
That activates if NFP confirms a cooling consumer. If people are losing jobs, that $7.1 billion EV loss becomes a lead weight, and it opens the door right back to the Q4 lows.
Finally, let's talk momentum. TLRY brands, TLRY. This is the high-volume pre-market play, up about 10% after a surprise Q3 earnings beat and improved guidance.
This is a classic gap and go setup. For you listeners, a gap and go just means the stock gapped higher on volume after news, and the momentum is strong enough to carry it further right through the open.
So what's the target?
The next psychological and technical resistance is 11.50. If volume really accelerates through the open, that is the target.
But the risk in these high-momentum plays is always there.
Oh, huge risk. This sector is prone to intense profit-taking, the classic sell the news action. So you have to use a tight leash here. A failure to hold the $10 psychological level early in the session means speculators are taking profit.
And could be a fast trip down.
A very fast trip back to the 850 consolidation zone. So trade the gap, but you have to respect the floor.
Okay, so we've covered the macro catalysts and the key movers. Let's unpack the technical levels that are defining this compression. Where is the institutional money positioned? Starting with the S&P 500 futures, the ES.
Well, we're hovering just below that psychological 7,000 handle, which confirms that momentum has diverged from price.
The divergence is undeniable.
Bulls pushed hard at the start of the year, but the market is telling us that rally is exhausted. Our line in the sand, the critical pivot for today, is 6,952.
And above that, resistance is heavy. R1 is 6,973. That's the recent all-time high. It's a massive sell wall. And then there's R2, the big one, 7,000.
The major psychological magnet and the crucial gamma flip zone. Breaking 7,000 would signal extreme bullish acceleration. However, if we fail to hold that 6,952 pivot, support comes into play. S1 is 6,913, the 4-hour 50-period moving average.
And below that.
S2 is down at 6,870. That's the weekly low and the structural floor.
So what does a failure to reclaim 6,973 tell us about the latecomers to this rally?
It confirms what we suspected. It becomes a liquidity trap for those late entry bulls who chase the January high. They are underwater, and if we hit S2 at 6,870, those positions get liquidated.
Now let's go to the Nasdaq 100, the NQ, our laggard in chief. High valuation tech is facing a clear growth scare with these AI-driven layoff headlines. Structurally, you have a clear symmetrical triangle that's formed on the H4 chart. That signals a massive directional move is brewing, but for now, the bias is clearly rotational out of tech. The pivot here is 25,514.
And resistance on the Nasdaq is steep. R1 is that heavy range from 25,833 up to 25,879.
That's the gateway to the upper structure. That's where you'd see a breakout confirmed. R2 is the all-time high at 26,283.
But the downside risk feels pretty severe here.
It is, especially with this tech rotation. S1, which absolutely must hold, is 25,450, the 50-day moving average. The final bullish defense is S2 at 25,345, the cycle low.
So what's the smart money doing?
They're waiting. Bulls are getting chopped up, trying to front-run a breakout. The smart money is waiting for clear acceptance above 25,880. If we lose S1, that tech correction accelerates very quickly.
So given the NFP report, the pending SCOTUS decision, what's the strategy for the active trader today? Are we looking at a breakout or liquidity trap? I think the liquidity trap scenario is highly probable. If NFP hits that Goldilocks zone, say 55,000, 65,000 jobs, it won't provide the clean direction the market desperately wants.
So you get a whipsaw move instead.
You get a classic whipsaw move. It's designed to liquidate as many leveraged positions as possible. We expect the algorithms to sweep the lows.
Specifically
25,340 on the Nasdaq and 6,870 on the S&P before suddenly reversing and just returning to the mid-range. It liquidates both the late shorts and the late longs. It's violent and completely directionless.
So a true confirmed breakout would require a much stronger confluence of events.
It requires a hawkish beat, meaning jobs come in significantly above 85,000, something that forces the Fed to rethink their dovish pivot. And you'd need positive news from the Supreme Court on those tariffs.
So the tactical edge is to be conservative.
Stay flat until 10:00 a.m. Eastern. Let the NFP algos burn themselves out. Let the market digest the SCOTUS news. The real move today, the sustainable one, is likely that rotation into industrials, the DJIA, as that military spending becomes the new alpha driver.
Speaking of rotation and risk, let's just revisit the yields, because that is the defining macro pain trade that I think a lot of retail investors are misinterpreting.
The misconception is widespread. Retail is buying the dip, operating on the assumption that bad news is good news. You know, a weak NFP means guaranteed Fed cuts.
They're waiting for the Fed to save them.
But the reality is the true pain trade, the move that causes the most damage, is a strong NFP print, something north of 85,000 jobs.
Why is that?
Because if jobs beat that hard, the 10-year yield doesn't just drift, it spikes. We're talking a move toward 4.60% in the short term. And the mechanism there is the Bear Steepener trap.
Can you just break that down? A Bear Steepener sounds complex. Why does it specifically hurt tech more than, say, industrials?
So think of it like this. A Bear Steepener is when long-term interest rates rise much faster than short-term rates. It signals sticky inflation and a Fed that's losing control of the long end of the curve. Growth companies are valued on profits they expect to earn 5 or 10 years from now.
Right.
When that long-term interest rate, the rate you use to discount those future profits back to today, when that skyrockets, those future earnings are worth dramatically less. It is the ultimate growth stock killer.
And you couple that high yield with the strong dollar index at 99.03, and you have a perfect storm.
The warning is loud and clear. Avoid chasing the pre-market green in tech this morning. The current yield is 4.19%. We need to watch that 4.20% level aggressively.
Why that level specifically?
If the 10-year breaches 4.28% before the 8:30 a.m. bell even rings, that signals a decisive shift. Expect a massive, violent deleveraging event right at the open.
So the crucial pivot today isn't just the NFP number. It's the reaction in the bond market right after.
That's it. If yields spike hard, that January effect, that early year buoyancy, it ends today. Regardless of where the S&P futures open, if the 10-year spikes, the market narrative flips to risk-off. This is a day for surgical risk management, not directional conviction.
Keep it tight. Trade the levels. See you at the bell.